Good afternoon. Good afternoon. Thank you so much. My name is Shillyboy Mothiba. I'm coming live on Wednesday, 5 p.m. And as I mentioned, every Wednesday. And the question of today is about structuring. And people always say, Shillyboy, how do I go about entering into a property space in a more tax efficient way? If, let's say, for instance, I'm already in business, whether being farming, being training, or whichever business that you might actually potentially be in. Now, let me give you a scenario. Let's take a scenario where someone is actually owner of a particular entity, let's say a farmer, but they want to diversify and they want to look into having a property investment business, or for that matter, it can be any other form of business. Would you agree with me? So what I've seen people traditionally doing, which I personally consider it to be inefficient, whether it be commercial efficiency or tax efficiency, they will then typically draw salary from that business and pay high marginal tax rate of about 45%. That's good for the economy, right? That's good for the fiscus. And some then will then do what we call pay dividends. I mean, if you look that and you multiply that and you get an effective tax rate, it's not a decent way. But because we need more money for tax base, I think I'll be happy in that context. However, if you apply the logic and the commercial sense and the viability of business and the efficiency of structuring your empire, and you want to grow business from that context, that wouldn't be ideal structure that one wants to enter into. But what should that person be doing, Shillyboy? Now, let's talk a scenario where you are referring to so-called Mr. X. Mr. X coming to see Shillyboy at TaxEduZA and Intergen and say, Shillyboy, structure my affairs. I want to embark on this journey of property investing, or I want to diversify in another form of business. However, I've got one entity. Now, let's name that old entity as old company. Right. Now, let's propose to Mr. X. Obviously, we'll be making a recommendation, but Mr. X is at liberty to decide what they see fit. Now, Mr. X says, Shillyboy, and I'll listen to your recommendation. Now, Mr. X decides, okay, let's have a newly formed company. We call it Company A. We say, Mr. X, let's use certain rollover provisions that is allowed in terms of the tax legislations, when we then change in exchange of the new shares in the Company A. Now the Company A owns the old company. Would you agree with me now? The relationship as it stands is Mr. X at the top, is the new company called Company A, and then the Company A owns old company underneath that. Would you agree with me? Now, can you imagine the picture? Okay, now you can. Now, the relationship doesn't end there. Remember, the ultimate outcome is to ensure that we start a newly formed company that will invest in property, whether it's a flipping, multi-let, whether it's buy-to-let, doesn't matter. That's his decision to worry about. We are worrying about creating a structure that is more efficient. Be mindful that in order to do so, a company can be formed either through taxable approach or in a tax-free approach. What I mean is that you can start a business by using assets and where you're paying tax for that particular reason, or you kickstart a business without having to pay tax. Now, let's say Mr. X now chooses to say, listen, Shillyboy, of course, I don't want to pay tax. I'd rather pay tax in future than me paying tax now. Would you agree with Mr. X that that is an ideal scenario? Now, for us to do that, then we decide, okay, Mr. X, let's form a new subsidiary. Let's call this new subsidiary company B. Now, would you agree with me now? The new structure is what? Is Mr. X at the top, is company A, and then the company A now owns two companies, owns old company and what? A company B, it's another new subsidiary. So can you see now the structure is at the top, Mr. X owns company A, and then company A owns old company and company B. Can you see the relationship, how it goes? Now, we all know that the money is sitting at old company. Yes, the money is sitting there. But then we want to make sure that now the money moves into a newly formed company B so that it can now start investing in property. How do we do that? There are many ways that can be actually applied. However, we just need to make sure that things make commercial sense. We also need to define to say, what is the relationship, business relationship over and above the ownership between company A and the old company? Is there any form of services that company A is providing to old company? Is there some sort of a management services? Is there some sort of an IT support? Is there some form of capital raising exercises? Is there any form of shared services can justify why company A should charge management fee to old company? Can you see now I'm trying to move money from the old company into the holding company, which is company B. Now that is crucial because it has to make commercial sense for us to justify why we should be charging management. You can't just charge management fee and then I ask you, what is this management fee? You're like, Shillyboy, I'm just charging management fee. That it's not gonna fly. So the management fee needs to make sense, needs to have the commercial grounds, and needs to be at arm's length, which means that it needs to be at market value. It needs to be realistic. If an external party was to provide such services to old company, what will they be charging? That is fundamental. You need to make sure that that is correctly structured. That is one aspect. One efficient way, if we don't have any form of justifiable reasons why the money should be moving to the company A from old company, we could consider declaring dividends. The beauty is that a declaring of dividends between companies is exempt from withholding tax. So which means that we can easily move money through dividends to the holding company, which in this case is company A, because remember we said company A is owning what? Old company, without worrying about having to pay withholding tax. Isn't that amazing? Great. Now that is great because now we're sitting with money with no future compliance things to worry about that is sitting in the company A. Now company A is free to decide on how it utilizes that money. It can pay Mr. X dividends for that matter, or it can decide to invest in company B. But remember, Mr. X told us that, no, we want to grow empire here. I want to create intergenerational wealth. I want to build multi-leds. I want to get involved in Airbnb investment, whatever the business model that he actually intends in going into. Now then, it's a matter of saying, okay, Shillyboy, then how do we then move money from the company A into company B, which is a newly formed subsidiary that is owned by company A? It can be many ways again. It can be through share subscription. Yes, the shares can be issued back into the company A in exchange of that capital injection. It could be a loan, commercial loan, right? That is also possible that we can do. We can also consider, instead of doing ordinary shares, consider what you call preference shares. That will depend on the business decision. The variable factors of each business needs to be considered, and the tax positions of all the stakeholders needs to be considered, because it's also crucial that that money that is moving in that company B is going to produce there. It needs to be producing taxable income so that it's able also to have an opportunity to deduct any form of expense attached to this particular money that is coming from company A. If it's a loan, that loan needs to be utilized to generate taxable income for the company A to enjoy the deductions of any form of interest being charged by company A. That is very, very fundamental. So that's, can you see that each person needs to determine what is their commercial reasons for the granting this movement of money. But then can you see that will have presented us with an opportunity to have now established a newly formed property company. Isn't that great? That is one aspect of it also, because also we could have moved money from old company through loans accounts, where we end up having what we call group loans accounts. That is quite of an admin. I don't like admin, but one can argue and say, in order to be successful in business, you need to be actually efficient when it comes to administrative functions. But I like things that are clean. I like things that don't have to worry about and having to reverse intercompany loans when I do group financial statements. So I would rather just have group dividends and move on with my life. So can you see that Mr. X would have now be cleanly and moving on a journey of creating a diversified group structure. He might worry about later and say, Shillyboy, listen, I don't want to be having this property or this ownership in my personal name. Can we start having a conversation about having a trust instead of me being the owner of the company A, which is ultimately the holding company? Now that's more advanced. Then we can say, listen, let's have a discussions, let's do a reassessment, restructuring, and then we do proper tax planning where you, Mr. X, because you feel like now you want to worry about continuity, we might have to worry about shared trusts and all those family trusts that needs to be considered, because now maybe you want to even move into other advanced financial products that you want to enter into private equity investment through your family trust. Yes, it gets more advanced as you're making more money in the property space. But in a nutshell, that's exactly how we can move money around and ensure that Mr. X is able to diversify his property instead of him having to distribute money first to himself and then distribute into a newly formed company for him to embark on a property investment journey, which I wouldn't recommend, right? I hope you understood my analogy. If you haven't, you're more than welcome to reach out to me and we can have a conversation slightly to say, okay, what did you say and what did you mean that Mr. X can actually move money around? I hope we are clear. That was the question of the week. How do I start property investment if I'm already in a different form of business, in a more tax efficient? And how do I restructure my business in a more, by the way, you might actually be having a property company. You don't have to be in farming. I just love farming, but you don't have to have been in farming. You could be doing a multi-let. Old company could be in multi-let, but now you want to go into a development. That's a different types of business. So you might want to consider a situation where you're creating a group structure so that you are able to actually accommodate a newly formed, because the risk profile is pretty much different. So for someone like me who's more conservative, you wouldn't want to actually be utilizing the same company in multi-let, and now you get into more risky business ventures, and then you actually end up compromising the properties that have been stabilized for some time. So you might want to look into those type of scenarios and then consider having group structures. But to avoid making mistakes, rather have a conversation with those in the know. So yes, all the best, and I wish you great until we meet next week, Wednesday, on the question of the week. Good luck.